And as I said, will the stock market crash? I have a ton of information here. I should say we have a ton of information here that I'm going to say is a little frightening. So let's get into the numbers. We're going to talk about this, kind of discussed this before, but the top 10 companies right now account for nearly 40% of the entire index. We've never seen anything like that. Even during the tech bust, I think it was around like 20-ish%. And then we've talked as well about the forward PE being around 22 times for the S&P 500, well above the 30-year average of about 17 times. So, I mean, looking at the forward earnings, the S&P is very expensive.
It's very expensive. And I mean, to your question of will the stock market crash, the answer to that question is always yes. That's what it does. It goes up and it goes down. But the point we're talking about here is all these metrics that we'll get into on the valuation and, why things are expensive. The S&P is, you talk about the market, the S&P, 500 companies, but it's really a very large portion of it is comprised of 10 companies, and all those 10 companies are extremely expensive, not from the stock price, but just in terms of how much earnings you get for those stock prices. But also the rest of the market too is fairly expensive as well.
Yeah, I mean, things are just very expensive, and I've kind of talked about this before, but if we were to go from, again, that 22 times multiple down to 17 times, I mean, that'd be a correction on the market of about 23%. And the issue is, you can kind of counteract that with obviously earnings growth. So let's even say earnings on the S&P grow by 5-7%. I mean, that then means to get what I'll call a fair value around 17 times. I mean, you'd still have a decline somewhere around 15, 16, 17%. So that's kind of where we're looking at. I mean, the earnings, you're paying too much for them at the end of the day. If you look back to the tech boom, I think it peaked out around 25 times the future earnings. And at this rate, I don't want to be here sitting, well, it could go to 25, 26 times. To me, the risk to reward of buying the S&P 500 at 22 times, hoping it goes to 25 times, not worth it.
And I mean, it definitely could do that. The valuations themselves are not what causes things to unwind and things to go down. You can't predict it. This is why nobody can time the market, because it's something unpredictable that comes along and causes the downcline, and then how out of whack the valuation is determines how drastic that decline could be. And again, we don't know when that is or what that looks like. It very well could go to 25 times future earnings, could go higher than that, who knows? And that could take a year or two or three, or however long it takes. But coming to the numbers, this is as expensive as really it's ever been.
Yeah, and I mean, we talk a lot about the future earnings, but there's other indicators too that are very troubling. And one that maybe is lesser known or not talked about as much, it's called the Buffett indicator, and that looks at the total U.S. stock market value compared to the U.S. GDP. And I thought this is kind of an interesting way to value stocks. And Buffett, and obviously referring to Warren Buffett, who is arguably, I would say, most would agree with this, is the greatest investor of all time.
Well, he's got the track record. He's 100 years old.
But he even made the claim at one point that this was the best single measure of where valuations stand at any given moment. The problem, it now exceeds 200%, which is a historic high and well above even the tech boom when it peaked around 150%. I mean, this is just crazy when you look at the valuation based off this Buffett indicator. Again, just another measure showing you how expensive the stock market is.
It's supposed to be around 100%. Right?
Somewhere around there,
I think that's what he said is a good value is the total market cap of all the U.S. companies should be about what the GDP is of the U.S. economy. So those should be in line. And at the tech boom, it was 150%. So that was a high valuation. Right now, 200%. So a different way of looking at it, as you said, different than what you're paying for the earnings. This is just the stock market, which at the end of the day, people putting money into the stock market, people buying things causes the market caps to increase. And so now the value of all those market caps together are, again, twice the size of the GDP of the U.S.
And I mean, it kind of makes sense because you're going to need, again, domestic production or the value of the economic kind of capacity to be somewhere in line with the value of the U.S. businesses, because if the GDP and the growth of the economy is not there, it's not going to be able to justify further growth in the stock market.
Long term, yeah.
Long term.
Short term, anything can happen. Long term, which is every decision should be made from a long term perspective.
Yeah, so I mean, that is, again, another valuation that is concerning. And a third one, too, that I was looking at that, again, maybe lesser known, lesser talked about, it's called the Shiller PE ratio. And what that looks at is the average inflation-adjusted earnings from the previous 10 years in relation to the current price of the index. And it's essentially trying to remove the cyclicality that comes about in, business and the economy over, again, those 10-year periods. But the multiple now stands around 39 times, which is also well above the 30-year average, 28.3. And at that level, we've only seen it really, again, during the tech boom. I mean, the fact that we're talking about all of these valuations historically just don't occur outside of one of the worst declines that we have ever seen, which was the tech bust. So, I mean, to bet on an increasing market at this value, it's troubling to me because, as we say, it can go higher. I personally think it will. I mean, you talk to people right now, and they're like, oh, well, yeah, I didn't do very well on this one, but I think I'm going to sell that and go buy NVIDIA. Or, oh, I think I'm going to sell that and go buy Microsoft. And I still think, it's kind of scary to say, but I still think there's more room in this bubble before it pops. And unfortunately, as there is continued growth in that bubble, I worry that downside just gets worse and worse.
And that's exactly what happens. And it's not only that, but it's also, people who are, have been very afraid of the stock market for a very long time, their whole lives, their whole adult life, their whole working life, whatever. People who are traditionally very afraid of investing in anything in the stock market are, well, I've heard about NVIDIA. I'm going to buy NVIDIA. I'm going to buy Apple. I'm going to buy Microsoft. And so you have money out there flowing into these things from people who, don't really understand what they're doing. They just see that something has done well. And as long as people continue to do that, as long as people continue to buy an asset, whatever it is, it will cause the price to go up no matter what the underlying, fundamental reason is.
And I think just because of that reason, that's why I think there is more room for this continued growth, is because we're still seeing people have these conversations, and you're not really seeing the ultimate level of skepticism where people are like, I don't know, NVIDIA is now worth over $4 trillion. Can it go to $8 trillion? People aren't talking about that to the same level of degree that they're talking about, yeah, but it's up 1,000% over the last X number of years, so I'm going to buy it. And, again, you use that example of people that hated the stock market buying NVIDIA. You talk to people and they have maybe a stock market index and they're like, yeah, but I also have NVIDIA. I mean, that is something that is troubling because that is, I think, fueling, again, the overvaluations in a lot of these stocks and, again, the S&P as a whole.
Yeah, which valuation doesn't matter until it does.
Yeah, and that's the hard part. And, we talk a lot about valuation, and it's funny, people don't care about valuation anymore. I mean, I care about valuation. I think you should care about valuation because ultimately that is the driver long term. But there's also some other factors in the stock market that are troubling. And a big one, and this one, when I saw this, I was taken aback by it, margin expansion. That can be disastrous. I mean, margin essentially allows investors to buy stocks with debt. But the big problem is if there is a decline and a margin call comes, well, the investor would either have to add more cash or make sells. Most of the time, if people are margining, they probably don't have the availability to add cash, so they would have to sell that position. That would then cause a further decline in the stock due to added selling pressure. So it can create this cascade effect where, selling starts, margin calls come, and then selling even accelerates to a further degree.
Yeah, and in this case, we're not talking about profit margin expansion. We're talking about margin in terms of debt, essentially leverage. And I think another part of that, too, is since there's been appreciation in the market, people don't want to sell things and realize the gains on those, so they'd rather borrow. And so what that can compound is if things do turn around, not only do you have margin calls where people, again, don't have the cash to put in because they're borrowing in the first place. If they wanted to invest, they would just invest the cash that they have, not borrow additional money to do it. But what that means is, that can cause things to come down. But if they're also then forced to then sell things that still have gains, now they also are going to owe taxes on that. So they have to sell to pay down the debt because the prices are falling, and they have to sell to potentially pay the tax bill on the assets that they have.
Yeah, I mean, so margin can be disastrous. And when you look at the underlying influence of it, debt generally is what can cause crises.
The biggest ones that we've ever experienced have been caused by debt.
Yeah. It can just derail an investment plan. It can derail a consumer. And I mean, when we look at the numbers here, margin debt has actually now topped $1 trillion, which is a record. And it has grown very quickly considering there was an 18% increase in margin usage from just April to June. This was one of the fastest 2-month increases on record. And this is what, again, scares me, rivals the 24.6% increase in December 1999 and the 20.3% increase in May 2007.
What's interesting about those dates?
Gosh, the next year was just absolutely terrible if you were an investor. And, this is just, again, another thing to add to, your arsenal, so to speak, about why things just aren't making sense right now. And, you talk about margin as a share of GDP. Again, looking at these relationships, it is now higher than during the dot-com bubble and near the all-time high that was reached in 2021. Even looking at 2021, what happened in 2022? Stock market fell 19%, I think, for the full year.
And interest rates were nothing at that point, so it was easy to borrow.
Yeah, exactly. And we also talk about another concern with margin is that doesn't even include what we call S blocks or equity-backed lines of credit. If you're borrowing against your portfolio, we call them generally S blocks. That is not part of margin, but that is another tool that people are using to maybe forego those capital gains and taking on debt instead. But the problem is they are still subject to the margin call, essentially, and I don't know if it's called a margin call.
It's called a maintenance call.
Maintenance call.
But same thing.
Where your portfolio goes down, let's say 20%, you leverage that portfolio. Now all of a sudden the bank calls and say, hey, actually, you're going to have to sell some stuff because we want our money back. Your assets no longer qualify you for essentially borrowing that amount of money. You then have to make sales. That then, again, adds further pressure.
I've also seen, because, Schwab offers these, Goldman Sachs offers, a lot of custodians offer those types of things. And again, a margin loan is you borrow against positions that you have to buy more stock. A securities-based line of credit is you borrow against your shares, but you don't use it to buy more stock. You're using it to buy something else, a car or a house or whatever. But the underlying collateral is the stock. So if the stock goes down, you still are forced to sell in the same way. And one thing I've noticed is a lot of these custodians are decreasing how much credit they're willing to extend. You used to be able to borrow like 65-70% of your portfolio. Now you can only borrow up to like 50%. But what that means is if somebody had a portfolio and at the time they borrowed maybe 45% of it, I'm still very far away from my margin or my maintenance call because I can borrow up to 75. Well, as those restrictions have gotten tighter, now they're very close to that if they can only borrow up to 50%, which could cause selling if there is some volatility.
And I don't know the exact history of these S blocks. I know margin's been around for obviously decades, but when you look at these S blocks, again, they're harder to kind of find. They're buried in the consumer kind of borrowing numbers. So the most recent number I could find was actually from Q1 2024, and it was estimated that the S blocks totaled about $138 billion. So again, even using that number, you add to $1 trillion, you're about $1.2 trillion. I would even assume we're higher because of this risk on because of the increased tax burden. I wouldn't be surprised if the S blocks were now pushing $200 billion, if not higher. Mm-hmm. But I don't know if S blocks were around back, in the tech boom and bust. I don't know if they were around during other financial calamities.
I don't think
it could cause further problems.
I don't think to the extent that they are. It seems like they're becoming more available for normal investors. Super wealthy people have used these things because they've never wanted to sell assets and pay taxes, so they would use credit lines to do things, whether it's a S block or any other type of loan that they would set up against their assets. But now it's becoming easier for retail investors to open this up. So this is a new line of credit that's becoming more prevalent.
Yeah, and this all kind of comes with the fact that we've been in this market where essentially you always buy the dip and it always comes back. Really, it's been that way for about 18 years. So it's created this whole investor base of people that have, number one, maybe never gone through an extended downturn, or number two, people that have short-term memories and forgot about the extended downturns.
Or they've gone through it, but not at the extent that they have. So
if you were 30, you didn't have much money back in the tech boom.
Yes, if you had, $20,000 and you lost half of it, it's $10,000, big deal. You might have heard at the time, but now if you have $3 million, losing $1.5 million on that hurts a whole lot more. So it's been close to 2 decades since we really have gone through something difficult.
Yeah, because you look at 2020, 2022. I think 2018 was another difficult year. Everything pretty much bounced back the next year. So that's why I always tell people, you go back over history. You got to understand that this is not normal to see these types of intense bounce backs.
It's not usually this easy.
Yeah, it's not usually this easy. That's a great way to put it. I mean, if you look at the tech boom and bust, and this again, put in perspective how troubling it was when valuations just got out of control. The S&P 500 fell 49% in the fallout from the dot-com bubble, and it took you about 7 years to recover. I mean, if you want to include the financial crisis in that, it took even longer because obviously you recovered about 2007, and then it crashed again in 2008. So, I mean, very difficult time period. The NASDAQ, on the other hand, which is way more growth heavy, the valuations were even probably way more out of control. That fared way worse. It dropped 79% during the tech bust, and it took you 15 years to get back to those record levels.
Yeah, I mean, you talk about taking an 80% loss. There's a lot of people in retirement that cannot handle that.
No, I don't know how you withdraw income while you're losing 80%.
I mean, you can't. You run out of money. You lose 80% as you're withdrawing money. You run out of money, especially since it took 15 years to come back. You're done.
Yeah. So, I mean, that is just why, again, valuation matters to us. And even, we talk about the tech boom and it's like, oh, it's different this time. I mean, there's other periods of history that we've seen similar situations. And I actually just recently learned about this one. But if you look back at the start of 1964, the Dow was at 874. By the end of 1981, it was 875. So again, over a 17-year period, you gained 1 point in the Dow. Now, this was an extremely difficult period that obviously saw the Vietnam War spending, stagflation, oil shocks, but it again illustrates that difficult markets with little to no advancement can occur.
Yeah.
And that is just something you have to keep in the back of your mind. Are we going to see a period of time over the next 15 years where we've appreciated something crazy like 12 to 15% on the S&P 500 over that time period? Again, I think it's much more likely you're going to see appreciation over the next 15 years of 0 than appreciation of 15% per year.
Right. I mean, it's possible. Who knows? Maybe these tech companies are all investing in AI, so maybe AI is going to be the greatest thing that's ever happened to humanity, and things just continue to increase forever. It's possible.
Do I want to make that bet?
It's also possible that things that have happened before, like we talk about the tech boom and bust all the time. We're beating that horse to death. But like you said, 1964 to 1981. So that stretch, no gain at all in the Dow. So it's not only the tech boom and bust. There's other periods in history, and it doesn't happen every year. But when it does happen, it lasts a very, very long time. And it's been a long time since something like that has happened. And we're not saying that that's going to happen next week, next month. Things could continue. Things could continue to go indefinitely. But generally that doesn't happen.
Yeah, and I mean, I don't want to scare you completely out of stocks. I don't think that's the goal here. I mean, You should still be investing your money. So, I mean, what are we doing? We're sticking to the value approach. Obviously, you listen to the show, we're value investors. Hasn't been the most successful strategy if you were buying NVIDIA or something else over the last 10 years, congratulations. But we stick to the value approach because during those difficult periods, value generally holds up much better. We look at the Russell 1000 Value Index as an example. It was actually up 7% in the year 2000 when the growth index fell about 22.4% that year. Even during the tech bust from 2000 to 2003, I think it was down around 15%, again, compared to a decline of 79% for those growth stocks in the NASDAQ. So that value approach can do well even when growth fails, or worst case, it holds up much better than the difficulties you can see in growth investing. Also, too, personally, we're holding the most cash we've held in the portfolio since about 2007. We're getting paid around 4% of money market. Take advantage of that. I think it is wise to maybe keep some cash, continue to look for good investments, and if you find them, it's not a bad idea to deploy some, but be very careful. I don't think you should be fully invested in this growth craze because, gosh, I think you could burn yourself 5-10 years down the road.
Yeah, no, I mean, and again, we will see how it goes. Things can continue until they can't anymore. I mean, nothing lasts forever.
Yeah, just one last topic on that. We spent a lot of time on it, but there's one other person that has a lot of cash right now. Warren Buffett, again, mentioned him quite a bit. Berkshire now has a record cash hoard near a record cash hoard, technically dipped a little bit, of $344.1 billion, and the conglomerate has been a net seller of stocks for the 11th quarter in a row. I don't know if that's telling of something. I believe it is, but I'd rather follow somebody like Buffett in this case than people Buffett. Chasing the meme stocks, chasing cryptocurrencies.
He's an idiot. He should just buy NVIDIA.
He's old
else.
School. Yeah, exactly.
He doesn't know anything.
So again, I mean, I want to be clear. Obviously, there's a lot of concerning data points out there. I think it really applies more to the broad-based market, to a lot of the growth sectors. I think there is still opportunity within the value segment. But if you're in those companies, congratulations, you've done well. I don't think it's going to continue, and
Go-
I could be wrong.
Go
but-
take a look at our newsletter, because this article, I think, has a lot of good information, because value investing is all about, price to earnings, what you're buying. But there's all these other indicators, and that article in the newsletter goes through all of these, and it illustrates some things. So, I think a lot of people would find that useful.
Yeah, and that is, again, just on the website, smartinvesting2000.com, if you actually want to read through the details of it. But with that, let's kind of jump to the